It's Doom and Gloom Week on this Energy and Materials edition of Industry Focus. Greetings, fools. Sean Riley here from Fool Headquarters in Alexandria, Virginia. It is February 25th, 2016, and joining me to talk all things energy and materials is Tyler Crow and Taylor Muckerman. What's up, guys?
Howdy.
Back.
So diving right in here.
Making it sound really bad. Doom and gloom. I mean, could we have actually called...
What else are we supposed to do in our sector?
Well, I was
what else
also
are we
gonna
supposed
say,
to do?
We could probably have called any week for the past 18 months Doom and Gloom Week.
I could have alluded to that guy on. It's always on Yahoo. That Faber guy or whatever. It's Dr. Doom.
Oh,
it's Dr.
yeah.
Doom Day or I don't know. Anyway,
It just seems like for the past 18 months, all we've talked about is like the bad news, doom and gloom. It seems like, why don't we just call it the Doom and Gloom Show? Because it's all
Gone are the days of our old energy show digging
it's
for
just
value.
before the dawn, Mr. Crow.
And digging for value was all fluff pieces about how great energy was doing.
Yeah. So you got, to your point, literally everybody's not doing so well right now.
That's
What we wanted to do was dive in and not pick out the whole sector for just stinking up the joint, but who got particularly pummeled in the last couple of months. Who did so badly that they just stand out and probably deserve to go bankrupt or something.
well.
Who goes first?
I hate saying somebody deserves to go bankrupt.
Nobody deserves to go bankrupt.
It sounds so harsh.
Yeah,
but
some people deserve to go back.
Taylor's.
If
a
you
little
believe
than
what
I am.
Saudi Arabia
Some people
said the other
deserve to
day,
go
he's like,
bankrupt.
what did he say at that conference? He was in Houston. He's just
He
like,
said lower costs
or get
liquidate.
out.
Yeah, basically.
Yeah.
Thank you so much for that sound economic principle. Anyway, all right. So who's up first?
I guess I will start. And one company that did really, it's been kind of one that we've talked about in the Motley Fool universe for a while. I do know it was a Motley Fool recommendation.
Yeah, a while ago.
For a little while, is Ultra Petroleum.
They're nat gas mostly.
They are a natural gas
Don't let
player.
the name fool you.
Don't let the name fool
Right.
you.
Mostly involved in what's called the Pinedale Powder River Basin area up in Wyoming. It's a very low cost, low decline, kind of conventional natural gas area.
This is why they were a fool pick. They were the lowest cost
Right.
natural gas producer.
Sounds like a country club.
Yeah.
Pinedale.
Yeah. But the reason that they have struggled so much is because they were levered out the nose. I mean, they just had a debt load that was, even 3 or 4 years ago, looked unsustainable. Even when gas prices were doing pretty well, everyone's like, you guys have a pretty high amount of debt on the balance sheet. What are you going to do about that? And as we've seen over the past, I think actually this was a quote from management. It just basically gives you an idea of what's happened. He says, we had net debt of about $3.4 billion, which has been fairly consistent since 2014. However, we have had EBITDA of approximately $800 million in 2014, $600 million in 2015, and forecast $300 million in 2016. So basically, they're saying that we're kind of
off the
losing
top of your head, do you know what their cost is? Because nat gas is like at $2 or whatever. So do you? Any numbers come
They're
to mind?
right around there, actually.
Okay.
Here's the issue though is we've talked about them being the lowest cost, which is great. Here's the other problem with it. It's all the way up in the mountains of Wyoming. And because of that, and all of those like gas hubs like the Barnett Shale in East Texas, and you've got Anadarko Basin right in Oklahoma, those are much closer to the demand sources. And so the transportation costs down to the Gulf Coast where most of our natural gas is consumed
Every pipeline winds up in Houston. So it's
is
like,
a lot less expensive. So the differential price that Ultra Petroleum is going to get because of that high transportation cost, their realized cost for actually selling it or realized price is already baked in lower. So you can say that you're the low cost producer, but then you also have to accept the fact that you're not going to get as robust of prices as everybody else.
Man, all right, Taylor, who had an unfairly rough last couple of months?
I don't think they're going to go bankrupt. Let's go ahead and prequel my
Is
comments.
Ultra bankrupt?
No,
No,
not yet.
they're almost-
They're talking about
Okay.
restructuring.
They're talking-
bankruptcy as an option.
There was a lot of talk on the conference call about
Strategic alternatives.
strategic alternatives and negotiating with our creditors.
Yeah.
I'm gonna make anyway.
Marathon Oil. According to Market Watch, first time in 20 years that it failed to turn a profit. So not that great for a full
No.
year of 2015.
Because a lot of the other major big name whatever oil companies, they're still profitable.
They're still
So, yeah.
profitable, based on their metrics. But they're also cutting spending next year this year, 2016, by a little over 50%. So they're still feeling the pain, cutting workforce by 20%. But the big thing here is that of that money that they're spending in 2016, 70% is going towards shale. So they're leaving very little room to spend on long tail projects, which is going to be the growth that you're going to see in 5 to 10 years. So I think that they're short changing themselves
Right.
by spending all this money on money. I mean, because they need to, right? They need these upfront cash flows in order to sustain capital, because they're already spending more than double their cash flow, right, on their capital expenditures in 2015. They're expected to spend more than they're going to bring in 2016. So they need these immediate cash flows, and that's unfortunate because in 5 to 10 years, what are shareholders going to have to hold on to? They're not going to continue to drive huge growth from shale for 15 more years. They're going to need these deep water projects. They're going to need these projects that don't require fracking and CO2 injections and water flooding. They need big projects, and they're not spending on it right now.
It's kind of interesting because ConocoPhillips did the exact same thing when they announced their earnings a little while ago. Is they are moving very, very far away from their deep water exploration, deep water development project.
And those are
their
the low-cost, long-tail things that you kind of want.
I wouldn't say deep water is necessarily lower cost.
Well, it's big upfront costs, but
Right.
later down the line.
Yeah,
You have
lower your
lower
production per
decline
barrel,
rates,
yeah.
so you have a consistent
Because
cash
what's the
flow.
decline? It's like 2 or 3% on those things.
A little higher than that.
Okay. Anyway.
But it's not 70%. the
Yeah, it's
first
not.
year.
It's
It's
not
not
that.
shale.
Yeah. Cool. So my company is not an oil-related company at all, but it is your friend and mine, Solar City.
Yeah, I think the two of us are going to look at you very, very attentively here because you have two shareholders in Solar City looking at you right now.
I swear I did not do this just to kind of
So
stick
he's doing it just to
Doom and gloom.
Yeah, I'm sorry. Anyway, you guys know full well. I just couldn't believe that this happened. But basically, I'm referring to the Nevada ruling that changed the rules for net metering within the state. It basically made rooftop solar uneconomic, and they did it retroactively. As I understand it, this is not a permanent decision. Could get changed in the future. Solar City obviously just bet the wrong way on this, and they just did not need this right now.
I mean, not only did they, kind of, I wouldn't say bet the wrong way, but the minute that
The ruling came out.
the ruling came out, they basically fired everybody. In the
It's
state
like,
of
all right,
Nevada.
we're leaving.
I mean, that's it. Yeah, they picked
They
up
left.
It's so. I could not. When I heard that, I was like, wow, this is really a big deal because
well, it shows you that they're
this is
nimble,
Nevada.
right?
Right.
If there's a
They're nimble.
state in the United States of America that's perfect for solar, it's them
You
in
would
Florida.
imagine.
Like, I don't know. Anyway, all right. So moving on to our next segment. 2 court cases that could kill pipeline companies' cash machine. Our listeners are probably aware if they've been just paying attention to a lot of our picks, but we all three of us have been saying that a lot of these pipeline players like Spectra Energy and Enterprise Products Partners and all those guys, they're kind of the babies that got thrown out with the bathwater in this huge market energy sell-off. Currently, and this is an article that was put out by the New York Times, 2 defunct companies, Sabine, I apologize. Oil and gas and Quicksilver Resources are, amongst other things, seeking to get rid of long-term contracts the two have with several midstream pipeline operators who count on the rates on these long-term distribution contracts to pay the dividends. Worse yet, in the article that was put up in the New York Times detailing the situation, an unnamed judge is asserted to be inclined to allow Sabine to end its contract with the Cheniere Energy subsidiary that operates the pipelines. Are you guys scared about this? And should we be selling all of our pipeline stocks now?
I'm not completely certain how to fully digest this one yet. I mean, it's one of those things when you read it, it does certainly throw up a red flag. One of the biggest things that they're talking about in this is throwing out minimum volume commitments, which is something that has kind of made hay for a lot of
It's
pipeline
absolutely
companies.
guaranteed money.
Right.
Well, yeah. So the contract, just for our listeners, between Sabine and the Cheniere Energy subsidiary, it was guaranteed volumes through 2023.
Right.
So this is not small potatoes.
Exactly. And so for some of these things, you're talking about small piddling companies, Sabine Oil and Gas and Quicksilver Resources
Right.
weren't exactly the largest names when it came to selling oil and gas and using pipeline space. The bigger fear is say you've got a large company,
Ultra
like
Petroleum, for
Ultra
instance.
Petroleum, or a Chesapeake
Every
Energy.
lawyer's favorite word is precedent.
Exactly. Somebody like a Chesapeake
Except for
Energy
the
or somebody like
defense.
that. And then what if one of those companies goes to, to a larger
Right.
pipeline company and says, we can't meet these volume commitments anymore, and we're going to take you to court on it. We've seen kind of the effects of that over the past year. One company in particular, Williams Partners, more than 20, I believe it's more than 20, it might be as high as 30% of their revenue stream comes specifically from Chesapeake Energy.
Wow.
And with Chesapeake Energy in the financial straits that it is right now,
Oh, they did just have an asset sale. Yay, $700
but
million.
if this minimum volume commitment contract
Goes
can
out,
get
yeah.
torn up, then you're looking at a pipeline company who's kind of left hat in hand. How am I
Right.
going to fill these pipes?
Taylor, I don't know how to word this, so I'm probably going to butcher it, but I was curious to get your thoughts. Isn't there an argument if you're the Cheniere Energy subsidiary or just one of the pipeline companies? Isn't there an argument to be made between, okay, listen, we've got these contracts with these guys. They're continuing to operate. Our contract isn't structurally the problem. They just got over leveraged and they just need to talk to the bondholders. Isn't
Yeah, it's absolutely the case. It's like, what the hell?
Right.
You sign this contract. Yeah, there's always
You're
gonna
still
be,
using us,
There's
probably.
always going to be a point where you're in a contract for 15 years that there's going to be a better opportunity out there. You can't just jump ship. I
Right.
mean, the comments that they made, like, argue that they could save $35 million by ending the contract and then save millions more by building an entirely new system. Yeah, exactly. I could sell my gas guzzling car that it's under lease and just not cancel the lease
'Cause I can
and then
get
go
a-
get an
yeah.
EV and save tons of money on gas, but I'd have to pay a fee to get
Right.
out of my lease.
And when you're
in a hy- in
bankrupt,
this
it's kinda hard to do
hypothetical-
that.
Yeah, exactly. So, and that's the thing. Like,
Yeah, where's the money
Use-
coming from to build this magical pipeline from the sky? Like,
this Cheniere company is obviously operating properly because they're not going bankrupt. Why
Right.
are you going to save a company that operated itself out of funds
right.
if they're just probably going to do it again if they get bailed out? I mean, I don't
Yeah.
understand it.
No, it
You're
just-
going to let this contagion spread to a sector that has largely been absolved from it, and I mean, it just totally bonkers.
Weird. Okay.
It seems to me, and so let's put in the hypothetical situation as an investor. If this is something that is legitimately an issue, one of the ways that I think you can maybe skirt or help yourself as an investor avoid as much of this issue is to look further down the stream of the pipe. So when you have a lot of the things that they're talking about here is mostly like gathering assets. So that's like taking an individual well and bringing it to a bigger pipe. Those are going to be the ones that are going to be at the most risk here because, Quicksilver Resources isn't going to keep drilling at that specific
Right.
well to keep that pipe filled. However, if you're to go from maybe like from a refiner to a distributor sort of pipeline network or larger pipelines that have
They're
consolidated all
considerably-
that gathering, then you're looking at somebody who's probably going to be a little bit more stable because despite you could see 60, 70% reduction on a gathering pipe, we're not going to see 10, 20, 30% production declines across the United States on large pipeline transportation networks.
Right. Got it. Okay. Before we move on, I wanted to point our listeners to the newly redesigned focus.fool.com. There you'll discover a offer to join the Motley Fool Stock Advisor newsletter at a special discounted rate. That rate is $129 for a full 2-year subscription. And once again, that is focus.fool.com. All right, so moving on. This is it's a speculative story, but we have to talk about it. How
have to?
fast we do, because it's a
Aw,
big
man,
deal. It's a
Dad.
big deal. This could destroy all of oil forever.
Fine, whatever.
Basically, how fast could electric cars disrupt the oil industry? Bloomberg just put out an interesting piece and a companion video under the headline, "Another oil crash is coming and there may be no recovery." Goes on to talk about how peak oil was clearly a myth. We could also talk about that because I have some thoughts. That once electric cars become increasingly popular via mass adoption, which isn't not far away, according to them, it could be as early as 2023. Oil screwed, basically. Pardon my French in not so many terms. How seriously should we take this? What are the potential holes in this analysis? And anybody at this table selling their oil shares because of Tesla right now?
No,
Okay.
but
We can leave now.
We're done.
this is like a pause for thought. Like, I mean, it's definitely going to be a big deal. I don't think in the next 3 to 5 years, which is what generally I'm looking at stocks to invest in for. You want the stocks that are going to be around 10, 15 years, but you have to imagine that with most companies in 5 years, you're going to have to reevaluate your investment thesis anyways. But this is definitely something that I think energy investors need to be worried about if you're projecting like decades of cash flows, because the OPEC and Exxon seem to
They
be
had that protection.
downplaying it to 1% of overall
They
vehicles.
had that video, and the OPEC has that report, and they're saying by 2040,
Yeah.
1% of the vehicles in the world are going to be electric. That
Whereas
seems really low to me.
Bloomberg says 35% will be electric. So there's a lot more room for error from OPEC's point of view.
Right.
Because it's not going to be less than what they expect, which would be a good thing for them. It's most likely going to be more than what they expect, which would be a bad thing for them.
Right.
The thing here, I think, you look at the increase in electricity needs when you have that many cars on the road.
Well, do we have enough lithium? I wanted to get your guys'
I
thoughts
think
on
there's
that.
plenty of lithium out there. It's like
Okay.
one of the most abundant resources in the ground.
Okay, that's good.
That's really not an issue.
Yeah, and so you've got that in cobalt. So maybe you look at some of these miners, but right now they're like, because it is so abundant, these miners
Right.
haven't been doing all that well. And then maybe some renewable utilities out there, because they're talking about needing 8% of current electricity use if this Bloomberg projection is correct in 2040. 8% of current production of electricity will be needed for electric vehicles.
Wow. Go ahead.
So I thought it was a very interesting thought piece. It really, one of the nice things about this is it makes you think about your thesis, and anybody who's a long-term investor, it really gets your mind flowing and trying to wrap your mind around some of the things that are going on that could totally transform industries. And the points that they make certainly have a case. One of the things they talked about mostly was what's called the S curve. It's a rate of adoption of a new technology, and what they're saying is that we're going to see a rapid acceleration of the S curve in the adoption of electric vehicles, mostly with companies like Tesla Motors, Chevrolet, and I believe Nissan. They're all within the next couple of years looking to bring out an electric vehicle in the $30,000 range, which makes it certainly much more affordable than what we've seen in the past couple of years. And then they made the comparison of rapid adoption of certain technologies. They mentioned things like refrigerators, microwaves, cell phones, things like that. And so there was the case to be made. And here were some of my counterpoints where I'm kind of looking at it and getting, okay, here are some of the things that I feel like don't quite jive with that idea. Let's start with the purchase and the adoption rate. Going to buy a refrigerator, a cell phone, something like that is a much more discretionary purchase.
Right.
Just $500 cell phone. Yeah, it's maybe a couple weeks paycheck or something like that, but it's not a $30,000 purchase. You're not going to immediately go turn in your car just because there's a cheap EV.
You are if you're saving.
Oh, you are, I guess.
You are if you're
apparently.
saving. You're just
yeah.
cashing it in.
Well, what about even they're talking about, there's a billion cars on the road right now in the world and blah, 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 blah. We're having a hard time here in the United States getting to electric cars, and we have theoretically, or could have pretty easily, the infrastructure for all the charging stations everywhere and everything. That's going to be hard in emerging markets like India, Africa. It's going to be harder than it is here, and we're not doing it super easily.
So, the integration of not just the electricity demand itself, but also the grid demands are going to be huge. And one of the things that I always feel like is slightly underestimated when we talk about these sort of things. They always look at the adoption rates in China and to a lesser degree India. But when we look at the developing world, there is a much, much wider swath that isn't really talked about a lot when we talk about oil demand, petroleum demand, things like that. And while we could see a decent decline of use from the developed nations such as ourselves, most of Europe, in more and more becoming China, what are considered the OECD nations, but at the same time, those developing markets are growing at such a rapid pace, and the expansion of GDP, population, I feel like the demographics of that are underestimated, and the demand for oil and energy are going to be so great from that I don't necessarily see how robust that argument can hold up when you have that much demand coming online.
The other thing that stuck out to me was the peak oil point, and that's fine. I agree that peak $20 oil is gone, but I'm not so sure that peak oil always and forever at certain costs is gone.
Please clarify. Go on.
Basically,
Do tell.
well, okay, so you guys remember in like 2008 and the books were coming out like
Right.
peak oil and all that stuff or whatever. And then what they're talking about is that is now a defunct thesis or whatever. My point is, and a lot of the analysis that I've read today is that was correct for $20 to $30 oil. Saudi Arabia still produces for $10 to $20 per barrel. We can't. We're shale's $50 or $60 with.
Some people are pushing it down a
gain.
little lower than that, but
But you
that's
see my
like that's
point.
prime
Yeah.
time acreage. Yeah.
And not only that, but U.S. shale production is projected to peak in like 2021, and all of a sudden we're in a decline again. So I'm not so sure that, because the first point the video made was because of advanced technologies and unanticipated things, we have way more oil than we ever thought we would. But really, this seems like more of a pause in a limited resource and our ability to get it out of the ground.
Seems like a fair enough assessment. I mean, if you look back historically, there have been these times, great example is the 80s where we were awash in oil and everybody said,
Yeah.
oh, we're going to be fine
You had
forever.
the North Sea, you had blah, blah, blah.
Between the cycles of, oh my God, we can't find any more oil.
Right.
All of a sudden, 10 years later, we're like, oh, what are we going to do with all this oil? So, I mean, that's certainly a valid point in terms of, trying to take the assessment that we have today and basically projecting it out.
Well, it was just in 2008 that oil went up to 130, gave it a high five, and Goldman Sachs was talking about $200 oil.
Yeah.
This is just 6 years ago, and all this $20 talk is funny to me. But
But
anyway,
if they can figure out how to extract more out of the ground, I mean, we're leaving a ton of oil
Right.
and natural gas in the shale, and so if you can figure out how to extract that, then. You
but
keep
that's
pushing.
expensive, which lends itself to my point.
It is, and it has been in the past, but it's always gotten cheaper. I'm not
is fair.
saying it's going to continue to get as cheap as it has been, like percentage wise, and as quickly. But I mean, Baker
We're going
Hughes-
really deep into this one
This
today.
is
I
like
like
a deep
this.
Baker
philosophical-
Hughes
The philosophical-
CEO
Do we need
came
like
out-
pipes or something to be doing this?
What's that?
we do need like
No,
pipes, like
maybe pipelines.
pipelines.
Maybe
Good
pipelines.
point.
But yeah, so
Cool.
that's my thought. Is like if we really need to, there's so much more underground we can get at.
Deep.
Yeah, way
The
deep.
human
This
spirit.
is so deep.
The human spirit, Taylor.
The American spirit.
Yeah, God. America.
America, man. We're the ones. Shale. That's ours.
It is ours. Although, what's his name? McClendon is going to Argentina, doing a little shale
So
drilling.
yeah, but that's American technology.
Oh, here we go. Anyway, all right. Good doom and gloom show, guys. Good.
Ended on an American high note.
Yeah.
There we go.
We need a bald eagle to fly in here.
That's
anyway,
right.
okay.
That was all the money we spent on our graphics
Yeah.
budget right there. Thanks, Taylor.
We got
Yep.
the yeah.
Collect my royalties for that later.
We'll give you a $5 bill. All right. Well, if you're a loyal listener and have questions or comments, we would love to hear from you. Just email us at industryfocus@fool.com. Again, that is industryfocus@fool.com. As always, people in this program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against those stocks. So don't buy or sell anything based solely on what you hear in this program. For Taylor Markman and Tyler Crow, I am Sean O'Reilly. Thanks for listening, and Fool on.